Hi everyone, it's Hannah here, and it's Monday again. Today we are talking about taking money from the company in the tax efficient way. So basically, this question I know lots of you are concerned about, especially if you're working within NHS and you are using the limited company to get paid. So you're concerned about this IR35 thing. But at this time of the year, it's coming into play from the new tax year, which is beginning of April. But then there are people, if you move into the private sector, thanks for the like, or if you kind of find out a way, like restructure your contract and still make sure you stay outside of IR35, or even you just run a business which is very profitable anyway. So you definitely will look out how you can take this money from your company in a tax efficient way. It's actually being asked all the time when people starting a company, starting a business, how they're going to take the money. And some people are more concerned than other people. Hi, thanks for the love. So basically, it's being asked all the time, and even until now, people knows IR35 is coming. They manage to find a way, stay outside of it, and then still asking how am I going to take money from the business. So to start with, first of all, we probably in one of my YouTube video, we talk about what's the difference between a sole trader and the limited company, and what's the pros and cons of running a limited company. So basically, if you are running as a sole trader, all the trading income coming as your personal income, and that money literally after you're paying off your expenses or your tax, it's yours. It's under your control. So as long as perhaps you only declare the tax return once a year, but then you probably, as long as you put money aside, you have enough money aside to pay for your tax, then you can just withdraw. You can just use whatever you want. But limited company is slightly different. So because it's like a limited company is like a separate entity. It's like a separate person. So, if you keep withdrawing money from the other person's bank account, then that's really it can be messy, basically. The other thing is, if there's no legitimate reason and why you're withdrawing the money from the separate person. But limited company, if you're in control of your limited company, you are the director. So there are two basic ways that you can withdraw money from the company legally. So one way is you can pay yourself a salary. So if you're a company director, you can put yourself under your own company's payroll and withdraw as a salary. Of course, it's like you are your own company's employee. When you're an employee, you have the pay slip every month, and you get, your tax has been taken off before you get paid. So it's the same way if you're on your own company's payroll. It's just your company is paying you, treating you as an employee. But there's a fundamental difference between you as a director putting on your own payroll and a normal employee. So first of all, as a company director, you're holding an office position, then minimum salary rule doesn't apply for you. So as you know, some of the company directors might not take salaries at all. They might just take a profit share, which is a dividend, which is something we'll talk about later on. So that's fine. And lots of people, if you're a one-man band company, lots of people's strategy is they take sort of a minimum salary, which is just cover the personal tax-free allowance, and then take the rest as dividends. It used to work really well, like a couple of years ago. It used to work really well because you have the up to about 30K, or roughly 30K tax-free dividends. But now, since current tax year, it's not anymore. But then still, overall, if we run the calculation, one thing, dividend doesn't attract national insurance, and then that's still cheaper than taking salary. So one of the ways is you can take salary, put yourself under your company's payroll, and pay yourself. Most of people pay monthly, but the frequency of the payroll is actually doesn't have to be monthly. You can do weekly if you want. That's obviously extra administrative burden, but you can do quarterly, or you can just run a yearly pay slip. So that's really up to you how often you want to run. But then at the end of the day, you have to make sure you deduct the right amount of tax, which is lots of people why they outsource a payroll to accountants or like payroll bureau. It's just to make sure they have the correct system, calculate all the PAYE and national insurance contribution correctly, as well as your employer's national insurance. So that's just a pay for the salary. That these are the things you have to do to prove these are the salary. And the good thing about salary, so why people, because earlier on we mentioned taking dividends is cheaper than taking salary. But why people still do that? And especially why there's a thing like take some salary and just cover your like personal tax-free allowance. Why is that? Basically, tax like this salary, if you like payroll cost, that's one of the tax deductions towards your company tax. So at the moment, the company tax rate is 20%. But if you say you take £10,000 per year as a salary, then you save £2,000 on the company tax. So that is why people tend to take salary, because first 10,000, like within the current tax year, is tax-free for you anyway. It doesn't attract any more tax burden. It might attract a minimum amount of national insurance, but then that's not a great amount. So it's quite a tax efficient way. But then straight away you save £2,000 from your company tax bill. So that's why people do that. So salary, that's a benefit. It's a tax deduction. And of course, if you pay normal employee, some people they say they have the like husband and wife, they have the wife as a secretary and pay them a salary as well. Or even for the kids, like they have kids 16 years old, put them on the salary. That's fine as well. So these are tax deduction and help you to maximize it. That's why people tend to do that. Okay, so that's salary. Of course, for salary, if you take certain amounts, normally it's around £8,000 a year, then you do attract national insurance contribution. It's on top of your tax. So that's what makes salary more expensive. So basically, you really need to see how much profit you made, first of all, and then secondly, like how you want to customize all these things to make it, to minimize the tax bill. But the other thing you need to be aware is don't try to minimize your salary just for the sake of saving tax, because every year as a company director you will declare your self-assessment. And when you submit your self-assessment, the taxman, they will compare your salary and the dividends. And if you high above that, if you do that, if the taxman say why you take so little salary and so much dividends, then they are not happy with it, because in the end you probably pay a lot of less tax than people for the same amount of income as salary. So they are not happy with that, and then they will ask you. They will probably just have lots of questions, and that's hassle. And they might make a decision, just deem everything as a salary or something. They might make some decision as well. So really, if you're a company owner, don't try to minimize your salary just for the sake of saving tax. So if you're running a business, like you're the proper CEO of the business, and if that's really profitable, I think the best way you do is really search for like the market rate of your salary. Say as a CEO of your position, like running the company of your size, what would be the reasonable amount of salary you take? say 30K a year or 50K a year. So run it accordingly, and then the rest you take as a profit share. But of course, if you really run a successful business and perhaps at some point you want to exit, then that's a different story. You might want to just dispose some of your share, and even just take the profit share and not take any salary at all. So that's a later story. But then that's say, for the salary, really don't try to minimize it just to avoid tax. Don't do that. Okay, and the other way we discuss is the dividends. So these are also the basic way. Dividends. What's the difference between salary and dividends? So if we say salary is a tax deduction, then dividends is not. Dividends is basically the profit share. So it's the profits is actually after the tax, after consider the company tax, then what's left over, that's for you, free for you to share, like as a shareholder. If you have 100% control of your company, then you can take up to that your profit after tax. But then, again, for the dividends, it used to be very tax efficient. Like a couple of years ago, it used to have roughly 30K tax-free dividends, but now not anymore. So what the rule is like from current year and the years going forward. So every individual you have every year, regardless of what your other income level, you will always have 5,000 tax-free dividends each year. So really, really look to maximize it. Especially now it's the end of the 16-17, and if you recently just set up a company or you're looking to distribute some profits and you haven't done that at all for the year, really look to maximize it before the year end, because after April, then you will have another 5,000 tax-free dividends. So really look at your if you haven't done so, look at your financial accounts, look at your financial situation now, and really evaluate if that's something you can maximize before the end of the tax year, and then so that you can have a 5,000 tax-free dividends for the short period of time. So that's what I would advise you to do. But then nowadays, the government is trying to put more tax burden on people who take dividends. So what's the rule is like? So at the moment, of course, after the tax-free dividends of £5,000, and if you take up to, it's really, again, that also need to consider your other income. So if you don't have other income, or you're taking like 11,000 as a salary already, and first 5,000 that's tax-free. But then after that, every penny you take up to roughly 43,000, that's overall of your like combination of your salary and dividends. So up to 43,000, then that's 7.5%. And then above that, that's 32.5. So that's how it calculates. And especially nowadays, the dividend tax becomes more expensive than before. Really, if your company is really making the big margin, do speak to the accountants or your advisor to really look at how you can customize it, how you can extract all these things to make sure your tax, it's not just say minimize the tax, but even if you want to take the same level of your take-home pay, how much you have to take and how much tax you have to put aside in order to pay the tax bill at a later date. So, and also need to be aware, because dividend tax, you only pay it through the self-assessment. So that might be the case that might trigger like second payment on account. So these are all the things need to be considered. I would really advise, like if your company is really having a big margin, or if you're a consultant, like consulting basis, and you don't have much expenses, and then you really want to look to how you can extract the money from your business, and do speak to advisor or your accountants. Really look at your situation and how they can customize it. But then, for this customization combination of these two, it's not the only way that you can be tax efficient. Even if you think, it does trigger the tax, but after that, there are other options. After all this money being extracted under your own name, there are other options you can consider to minimize your personal tax bill. Well, we, like early on in the IR35 episode, we talk about pension contribution, we talk about venture capital trust. So these are the tax efficient ways that the strategies you can implement. So pension contribution basically it can be highly beneficial. So if you are a basic rate taxpayer, for every 80 pence you contribute, then taxman that you will top up 20p. For the venture capital trust, actually last episode we have the expert here. We talked about that, the tax benefit of that. That's a very lucrative tax relief. So really refer to our last episode and really look into details if that's something you want to look into, you want to invest in. So because every £10,000 you invest, the money of course is still your equity, but then you get £3,000 back from the government. So that's very generous tax relief. So do look into that. Do look into the last episode for the details. It's a very sophisticated investment. So do look into it. Okay, so that's dividends. Basically, the other question people ask is how often they can take as dividends. Well, it's entirely up to you, like how often you want to withdraw. You can take monthly, you can take quarterly, or you can even just take it once a year after the company tax return is done, and you can just take it after year end. That's fine as well. So it's really up to you how often you want to take it. But then in terms of taking salary or taking dividends, it does depend on the individual situation. So just give some illustration, probably very common happen in the past, like the cases I dealt with. Of course, the very basic thing is a one-man band person. That person is single. No one is going to share the company with him or her. So perhaps like a low dividends, low salary and high dividends strategy can work really well. Although like low salary and high dividend strategy at the moment it's not as beneficial than as before, but still it's a considerable, it's a more relatively more beneficial strategy than just taking everything as salary or just taking everything as dividends. So if that's just an individual, like a one-man band, then still like relatively low salary or relatively high dividends, that's still the strategy to go. But again, as I mentioned, don't try to lower your salary just for the sake of want to wipe out the tax burden. Don't do that. Okay. And the other scenario is someone who has perhaps running a consulting business or just run a company on the side. And at the same time, he or she has a salaried job. It really depends on your level of earning as a salary. But then in this case, majority of the cases, we would advise don't take salary at all. Because in this case, you as a shareholder, you can just take the dividends, it's fine. So you can just take a profit share. Because anything you withdraw as a salary from the company, straight away it will trigger tax burden. Because from your other salary, you're already paying 20% of tax. Then you already use up all the a tax allowance. So any additional salary you take, you trigger the tax burden straight away. So in these cases, if individuals have these cases, then most of the time we do advise just to take dividends, just take profit share, don't consider salary. But again, for some specific cases, it will be different as well. Perhaps some people will prefer take some salary, or they have a contract even though you are the director holding office position, but you want to treat yourself properly as an employee, you're holding a contract between yourself and your own company, then that's a different scenario. Because in that case, if you have an employment contract, that's become a formalized employee. So perhaps you will need to think about the minimum wage, this kind of thing. So that's a different story. But then it's just most of cases they only take dividends, and still they can benefit from taking the first 5K tax-free dividends. Okay, so that's like a strategy, and of course there's other strategy like husband and wife. If you just have a family business, husband and wife, and you just take 50-50, allocate 50-50, or accordingly to your other level of income. Say your wife already have some sort of a salaried job, then perhaps you just allocate slightly less percentage of a share to her, and then you gain more control. But again, these again don't try to allocate just for the sake of saving, like paying less tax only. Really look at the situation. If your wife is going to be one of shareholders, perhaps she will have some control of the company as well. She will have some stake of the company. So what's her involvement? What's her role within the company? So all this need to be considered. Or if you want to have a wife as a partnership, what's her role? So really need to look at all this. Make sure it's valid. Just don't try to just look like just try to avoid the tax. That doesn't work. The company is never be a like tax avoidance vehicle. It's the main purpose of the company is making money, doing a business, and really benefit other people. Of course, we need to be tax efficient along the way, but that's not your main purpose of setting up this company. Okay, so basically salary and the dividends, these are the fundamental ways of taking money from the company. Of course, like in terms of how you're going to customize it, do talk to the advisor, do seek for professional advice, really see the numbers, and then give you the best choice. Okay, so after this, there's actually quite commonly another issue raised when it comes to taking money from the company. What if you just randomly withdraw the money and you don't call it salary, you don't call it dividends? What are they? In this case, because your company is like a separate person, separate from you, then it's like the other person is lending you money. Then that's director's loan. So if your loan like a company is lending you money, at some point you have to pay it back. So what's current rule says is that you can take director loan whenever you want, however you want, but then the sort of you have to draw the line that after 9 months of your financial period, you have to repay it back. Otherwise, any balance due will be charged. Will have the tax charge at 25%. So that's something you need to be aware. So majority of the cases, perhaps they need some money very urgently during the year, then they just take. That's fine. But then after the year ends, when the accountants finalize the company tax return, run the numbers, and then declare the amount as dividends. So that's one of the ways you can prove you repay the money back to the company, because you declare as dividends. So that is fine. But then what if you overdraw and then you don't have enough to declare? Because they give you 9 months as well, so you can extend it 9 months, as long as like after 9 months, 9 months after your financial period's finished, then the balance is zero, on you repay it back completely, then that is fine. So really look at the numbers. That's why after all this actually director's loan issue, perhaps lots of people are not aware of it. But then it's always been asked, like, what if I take the money randomly from the company? So that's what's going to happen. And the other way, of course, if you do take money from the company, you don't have to repay it in a way that is that is declaring dividends. The other way, just if you want, just repay it back physically. But here's the thing, because some people, they might be really smart. They might just trying to play cute. Because you have the deadline of 9 months after the financial period, so they repay it back. Like, say for instance, 9 months, the date was 31st of October. 9 months, that's a deadline. So they physically repay the amount back to the company on the 31st of October, and then that's completely clear the director's loans balance. So they just say, yeah, I don't have to pay any extra charge. But the next day, that person take the money back. So that's just like he's trying to avoid that tax charge, but then at the same time, he will still want to enjoy that amount of money. So at the moment, it's not allowed. The money has to be repaid, have to stay in the company for at least 30 days. So just the government's just trying to minimize this sort of behavior, minimize people who are trying to play cute. So they have this 30-day rule. So that's something you need to be aware. If you do take money randomly from the company, yeah, it's not a big deal if you need the money from the company and withdraw it. That's fine, as long as at the end of the day we can declare as dividends and can clear it out. Then that is okay. But then again, when you are doing, especially if you're doing nothing, if you're just want to have minimal involvement, at least once the financial accounts is finalized, really look at the financial accounts once the accounting period is finished, and then any director's loan, you can have a strategy to repay it back. So that's basically what I would advise people to do. Okay, so there's a few ways, but then the other thing, perhaps when people say taking money from the company, they might not be aware of, but then because perhaps you are the director of the company and you treat yourself the employee of your own company, then you can benefit from some employee perks, especially you're on your own payroll. So this actually, a lot of people, they probably missed out or didn't realize. As we mentioned, like your first mobile phone, every employee's first mobile phone, these are tax-free benefits. So you can reimburse yourself your mobile phone, the one mobile phone. Don't if you have like 5 mobile phones, don't try to claim all of them, but one of them. Yeah, the one you use to call your clients, use to call your business partners, use that one. Okay, and the other thing, use of home. I think on our second episode, we talk about maximize the deductions when you work from home. So that's something you can reimburse yourself, because most of the time you pay your utility, pay your rent out of your own pocket. But then that's something you can ask your accountant to calculate for you and reimburse yourself. That doesn't trigger additional tax burden. And the third thing, if you drive, use your own car, but then some of them are your business journeys, you can claim mileage as well. So really record your mileage. Again, there are people don't keep the mileage, or just very randomly they think perhaps the petrol they can claim, but then it's best to keep the mileage, and then you can claim the mileage allowance for the first 10,000 miles. That's 45p per mile. So that's how it works. That at the end of the financial year, or when you calculate all these things, you can actually take this extra money out from the company without triggering additional tax burden. And of course, travel and subsistence. Travel, you go especially stay into the overseas. For instance, if you stay overseas for business, then the flight is a deduction, is a perk. And of course, like for the travel, some people, it's actually travel and accommodation, like overseas travel, all these things, if you run a business, is actually quite interesting part, because perhaps most people think, yeah, we just go on for holiday. But then, if you're a business owner, there are things you can do. Perhaps you just try to do some market research to your favorite destination and claim that as your business expense. That's something you can do. It's actually when it comes to when mentioned about this travel thing, we actually have our own exclusive Facebook group. It's called Tax Deductible Lifestyle Tribe. So this is purely exclusive for people who are interested in how they can save more tax legally, and how they can learn more about these sort of tricks, like legal strategies to reduce the tax bill or about taking care of the finances. So if you are interested in that and serious about that, do be free to join that group. That is a closed group. Later on today, I will talk into the comments the name of the group again, so you can search for it. But then that's a closed group. Anything happen in the group, stay in the group. But again, the Q&A is still public. Okay, so travel. In that group, we will talk quite a lot of tips on how you can make your vacation tax deductible. The tips like how you can make this deductible, that deductible legally. So they will have a lot more contents, a lot more tips to share, and more into details. Okay, so if you're interested, be free to join that group. Okay, and other things like childcare. So actually, if you run a business, and then currently you can still benefit from like employer supported childcare. So basically, your company will register with the childcare provider. Say you provide this childcare voucher to employees, then you can claim up to £55 per week. Then that's tax free. So that's another perk, like childcare. But of course, for the childcare, it's a very big topic. Especially currently, government is proposing like having a new childcare scheme, like a tax-free childcare. So we will definitely have one session just focus on childcare. Okay, and finally, there's the employer's pension contribution. It's different from the pension contribution out from your pockets. That's actually the employer's, the company will have a scheme, and then contribute pension, do the pension contribution on your behalf. So that's tax deductible as well. So especially now we have the auto enrollment for all the small businesses. You have to automatically enroll your employees to the pension scheme. So that is any money you contribute to the pension scheme on behalf of your employee, these are tax free. So if you do want to look into that, or if you're staging date, because it's becoming an obligation for all businesses, no matter how small you are, apart from if you are like a one-man band and you are the only director, that doesn't apply to you. But if you do have employees other than office position, then it is 95% of a chance you will be you need to look into it. Okay, so pension contribution. But of course, that doesn't limit to this. There are a lot more things, like perhaps a lot more other things you can reimburse yourself to, as long as it's business related, like even your equipment, or for some cases, some certain amount of relocation cost. Things like that. So there are a lot of perks you can take. So don't forget to maximize all these things. Make sure you do the reimbursement first. Well, I think the best order when considering the taking money is consider salary, take some salary, run the payslip, and consider reimbursement, then the dividends. Because at the end of the day, we want to prioritize the ones that's the reimbursement doesn't trigger additional tax burden, and then we consider the dividends on top of that. So this combination, then we can see, you can withdraw your money from the business in a tax efficient way. But again, these are just for the general guideline, and it's based on the cases I've done before and the type of people I've seen before. There are perhaps certain scenarios, things will be completely different. This sort of episode is purely for the education, for giving you more information, but that's not a replacement of tailored professional advice. If you do look into speak to an advisor, either if you have an accountant already, speak to them, or if you want, speak to me, myself as well. So I'm happy to help. And again, finally, we mentioned the Facebook group. So in the group, we will actually have this sort of education in more details. And the bonus of that is we do have the panel of experts. So if you're looking to have a help, find help in tax, and if you want to also, do the sort of look into your financial planning, then we have a financial advisor there as well. Or if your business is stuck in cash flow, we have a cash flow consultant there as well. Or people who want to have any money issue, we have people who are like consultants who specialize in this. So if you really would like to sort of take control of your money, really enjoy your money and use your money to do good, then yeah, be free to join the group. I will put the name of the group in one of the comments, and just copy paste and search for the group, and I will prove you into the group, and then we take it from there. So, as mentioned, perhaps the most interesting conversation will happen after the episode. And please be free to comment or ask any questions if you want. And if you think anyone else would benefit from this episode, be free to share the video. The replay will also be on YouTube as well, so it will be sent out, as well as our newsletters on weekly basis. So, okay, thanks guys for listening. You've been really good audience. And then I shall see you soon. Bye now.